Good afternoon, everybody. It is Wednesday, the 11th of August, 2010. Not sure what the audio difficulties were with my machine for the Stock Twitch show, but let's go ahead and take a look at this market. Obviously, we had a pretty rough session here today. The S&P lost 2.74%, came right down to that 200-day moving average, or 50-day moving average rather, and this prior level of support, which is the basis of these higher lows and higher highs. So the market is really kind of back to the middle of what's really set up as this range of 105 to 113, and we find ourselves, like I said, in the middle of it with a flattened out 50-day moving average. We were rejected on the weekly time frame with a lower high, so that brings about a larger reason for concern that we did not breach this high here, and even so, we were only just a couple pennies away. But technically, we have a pattern of lower highs and lower lows intact on the weekly time frame. In order to continue that trend lower, we would have to break below that 102 level, which is quite a distance away. And it was also, if you recall, the 38.2% retracement of last year's low to this year's high. Now, I think if we do get down below that, then eventually we're going to see a 50% retracement down towards the next logical level where this prior resistance was at 95 bucks a share. But that's on the bigger picture. Right now, we have to stay a little bit more focused on these near-term trends and take a look at what the implications here are. So we came down to this 119.25 to 1950 level that I'd mentioned last night on the blog as a bigger level where we would expect to encounter hopefully some support if the 110 level broke down. I certainly wasn't expecting, the 111 and 110. I wasn't expecting these levels to break, but obviously they did. We had this big gap lower that took us right down through those more important levels. And just yesterday, it was kind of looking encouraging because we had this lower high here, and it looked like it was going to set up to maybe push out through that 113 level. But as I had noted, that we didn't want to take any strong positions ahead of that because it was still in a really dangerous area where those who got long obviously got hurt badly today. Now, if you had taken a shot on the short side, congratulations, it did work. It's not what I would have considered the higher probability trade, but it did work, and you're richer for it today, and that's a good thing. There's all kinds of different ways to trade this market, and you've got to find the one that makes most sense for you. I was mentioning to subscribers yesterday that the biggest reason for concern really was the Russell 2000 and the financials, that these markets yesterday had failed to recover with the same magnitude that the broader markets did, and we were below the declining 5-day moving average on that Russell 2000, and also on the 5-day moving average, we were below that, which was declining on the financials. We'll get back to those in a minute. Let's go back to the S&P 500 first. So on the 30-minute time frame, we were looking at that trend line from the lows last month, and obviously that's clearly been broken. I pointed out this morning that the more times any type of support is tested, the more likely it is to fail. I did, however, think that we were going to maybe test the lower end of that and stay within this range, but obviously when we gapped down through it and we got stuck below it, below the declining volume weighted average price, there was a brief blip up through there this morning, but it was declining the whole time, and it was just steady selling throughout the day. The volume was about what it was yesterday. I'd actually seen on television that someone had said, well, we're down, it's light volume. Come on, I mean, it's summer, it's light volume in general, but today's volume was a little bit heavier than what we have seen compared to the 20-day average. So it does show that there was obviously a lack of bids in this market, and there was a real panic move, and the market came down to that bigger level where you would expect to, or hope to find some support, because it was this prior level of support that was the basis of these higher lows and the 50-day moving average. So we're looking at this market now, and what's ahead for tomorrow? Most likely some consolidation after this big drop down to this important level, but we have to be prepared for anything. The short-term trend says there's no evidence that the buyers are regaining control in here, and that means we have to remain very cautious. And just because it's the 50-day moving average and just because it's the prior level of support doesn't mean it will continue to be so. A lot of times these markets might flush down through that level. But the bigger level of the bigger range that this market is in really is that 105 to 113, and here we are, pretty much smack in the midpoint of it, where that 50-day moving average is. So perhaps we're going to consolidate a little bit further here. That's anyone's guess, but I would say that you want to, before looking to initiate new long positions, you want to definitely allow this market to begin to stabilize, and then and right now the odds just don't favor it. With that declining 5-day moving average, you're going to look at these rallies as guilty till proven innocent. Prior levels of support will now be viewed as likely areas of resistance if this market does get a bounce. And of course, you can day trade those bounces if that's your aggressive nature. And I would say generally, you just want to trade your day trades in the direction of the volume weighted average price. So let's take a look at the NASDAQ now, which broke an important support level also at $46 a share. We can see that level was right here. That was the level we've really kind of been focusing on as support back in here and the basis of this gap. So the market came down to the next logical level where we'd expect to find support at that 45.10 to 45.20 level, and we have a declining 5-day moving average. So same thing here, is any rally you would look to see that 46 would likely become resistance and the basis of lower highs and lower lows. On the daily time frame, we're right down to that 50-day moving average as well. Perhaps we bleed it out a little bit further just to kind of panic people, but there's still in this market, obviously there's zero signs that the buyers have stepped in. This is just a very short-term little consolidation, and it held up, I guess, a little bit better than the S&P at the end of the day. However, the percentage down move is almost identical to the S&P, and it's interesting that we are once again negative on these markets after being above that break even for the year for a couple sessions. The Russell 2000, as I mentioned, was a reason for concern yesterday because it was below that declining 5-day moving average. We were looking at this 64 as an important support level, that if that was broken, then it would definitely mean the rest of the markets would be weak as well, and obviously they were right from the beginning. But the Russell was down 3.9%, so there's definitely further weakness in this group. If you look at the bigger range in here, X a couple days, basically the low end of the range is at about 60 bucks a share. So it's still possible we could go down to that level and even break it, of course, because you look at the weekly time frame, it is in a confirmed downtrend, lower highs and lower lows. We don't have the next lower low yet, but if we break down obviously through 60, I think that's going to bring about a real reason for concern that we could see, and not immediately, but we could see that 56 level. You have to take these sell-offs seriously. We're back below the 50-day moving average, and now the bigger level of resistance for this Russell 2000 is likely to be found on any bounces up towards 64 bucks a share, and getting up to 64, I think, is really kind of unlikely at this point, but it's a possibility, again, if you're a more aggressive day trader. The semiconductors broke down through their important level as well, which was 27.50. That doesn't bode well for the market. Obviously, the 29 level was the big support, 25.5 basically. I'm sorry, resistance up at 29. 25.5 looks like we could be headed for a test of that, the low end of this range. We broke the midpoint of it, so you look at the semiconductors, they have been a group that often leads the broader market, and if that's the case, then we have to look at this S&P 500 and say, this area is in real danger of being broken, maybe not tomorrow or the day after, but after another little bounce attempt, or even at some stability in here. So these semiconductors are broadcasting reason for bigger concern. Also, we have the financials, which, as I'd said earlier, were a reason for concern yesterday because they hadn't made it above that declining 5-day moving average, and they were showing this pattern of lower highs and lower lows on the 10-minute time frame. We had the attempt of a higher low in here. We were going to wait for a move back above 15 before considering any long positions in the financials. So obviously this little breakout attempt completely failed, and from that failed move, now we've got this fast move. It looks like the low end of this range is likely in the near term at 1375, and if we break that, then we're going to have to start looking at the 50% retracement and that sort of thing on the weekly time frame. You look at these financials, it's just not encouraging at all. We've got all those moving averages declining, and we're below them. So it's really we're in a very bearish environment here right now, and things really changed quickly. And that's why you have to listen to the message of the market. That when the market is up at these areas, these important battlegrounds, the 113.20 area, it said wait for further evidence. Well, we've got that evidence, and now we have to listen for more evidence and more information, basically, to say what's next. But you look around at the financials, you look at the semiconductors, it doesn't paint a pretty picture for this market.